Today, my guest is Lior Gantz. Lior is the founder and editor of the free #1 rated financial newsletter, Wealth Research Group. He's an investor, and in just a minute, we're going to talk with Lior about the real economy versus the stock market. But first, a quick reminder, if you like the show, CREPN Radio, there's a couple things you can do. You can like, share, and subscribe. And as always, we would love for you to leave a comment. We'd love to hear from our listeners. Also, if you'd like to see how handsome our guests are, be sure to check out our YouTube channel. And you can find us on YouTube at Commercial Real Estate Pro Network. With that, I want to welcome back Lior to CREPN Radio. Lior, welcome back.
Thank you, sir. Thank you for having me back.
Well, I'm looking forward to our talk today. I think the last time we were together, things were a little different. There was no pandemic, and just definitely some different circumstances. But before we get started, if you could just take a minute and share with the listeners a little bit about your background.
Okay. I'm 36, and when I was 13, I think I had a pivotal moment in my life where my father's business went under, and I had to start earning money for myself if I wanted allowance and stuff. So I started babysitting in my neighborhood, and then I told all the parents that I was babysitting, at least the male, children, that I can tutor them in basketball. So I upsold the parents for the first time in my life. I upsold something, and then babysat, tutored basketball, and started saving money. I'm 16. I have $20,000 in the bank saved up from like 3 years of this stuff. And the banker says, well, you have all this money. Why don't you invest it? Why don't you make your money work? And I'm, what does that mean? This, well, you invest in the stock market. Get your parents to sign a waiver. You're 16, get your parents to sign a waiver, and we can start doing this. And this was June of 2000. So like 3 months after the dot-com bubble burst. So in hindsight, a very good time to start investing. And he was like, you should see China. And so he was literally telling me great stuff. And then I asked him, what should I learn? Because I was in high school. So, my mind is like, what book should I read? Amazon was just starting to ship books. So I bought a bunch of books in English and started tearing through them. And that's how I got into investing. My father had a second business and a third business, both going under as well. So my mind was obsessed about risk and what's he missing? Because a father figure is very important in your life. You always assume he's a hero, and here's this guy failing and failing and failing. So by the time I'm 23, I am so engaged in entrepreneurship and business and how to do it right. And that's the path I took in life, entrepreneurship and investing. And about 4 years ago, it sunk to me that most people do not read, one book a week for their entire 20s. And most people do not have financial education. So I said, let me congest everything that I'm doing, because I'm reading 4 hours a day, and I talk to CEOs, and I do the business, and I run my own business. And let me congest it to a bite-sized article 3 times a week about the economy, what's going on. If I see specific opportunities, then to cover them as well. And that's how we founded Wealth Research Group in 2016. It's a free letter. It was one of the first letters to cover Bitcoin, $400 per coin. In early 2017. It was the first newsletter that I know of that covered Ethereum, which was a cryptocurrency that traded for $12 when I covered it, and $1,000 6 months later. Last year when I was on your show, we talked about gold. Gold is actually, as we're doing this interview, is in an all-time high. So, that's sort of the way that the newsletter works. We really talk a lot about the economy, and we try to see exactly what's really important for people to get educated on right now and to cover it.
So let me ask you, I'll say the average consumer, myself included, You turn on the news. There's a blip, usually about the market rallied or the market gave back, but it's usually focused around the indexes. You've got your Dow or your um, what A and
The Dow, the S&P 500, and the
yeah,
Nasdaq.
S&P, yeah, Nasdaq and the S&P 500. Um, and those are kind of like just these reference points that are kind of like a collection of multiple stocks and an index. And I think if I recall, the Dow is the collective price of multiple stocks.
30,
Is it
30
the
industrials, the 30 biggest industrial stocks. Yeah.
okay? So their price combined equals this index
Um,
price. Is
yes
that
and
right?
no.
Okay.
It's weighted on the market cap. So it's not like each company is 3% of the index of the index. It's weighted according to your
The
to your
industry
yeah, no, to your size, to your
to
market.
yours. Okay. Gotcha.
Yeah.
Gotcha. All right. So if the average person is watching the news and they see it's up, it's down, it's up, it's down, it's up, it's
Hmm.
down, and
Hmm.
you have some sort of a reference point. I mean, like right now, I know when this whole COVID thing started, I think we were closing in on 29, or we were at 29,000 for the Dow.
Great. Yeah.
Um, and since then, I think yesterday I was watching, it's been hovering 26, close to 27.
Yeah.
Uh,
Just above 27 right now. Yeah.
Okay. And so I mean, you look at that and you say it's down, what is that,
10%.
6%, 10%? Okay.
Yeah. From the highs. Yeah.
Okay. And all things considered, that seems like not a horrible place to be considering what's taken place.
Hmm.
Um, my concern, and I think that one of the challenges for really understanding what does that mean when you have all of this governmental interaction with the supporting of the markets and the kind of propping up the markets. How do you take a look at that and sort through that? Is there any kind of a sense of a false market there that's if the government doesn't continue supporting it, that it collapses, or is there a weight given, or help me understand how somebody that studies this day in and day out, looks at that and views it.
So that is literally the question of questions that is on everybody's minds. From the retail investor to the hedge fund manager to Warren Buffett. Everyone is literally trying to understand if this market is what we call artificial, if it's fake, and if it's fake, what's the real price? And if it's not fake, how am I getting it wrong? Why do I think it's fake and it's not? So the first thing you want to look at is earnings. Um, when you buy an index when you buy shares of the Dow Jones or shares of the S&P 500 points, the S&P 500, etc., what you're buying is a collection of companies, and now you own a piece of them. And the first thing when you buy a company, if it's a private company, if it's a laundromat or a restaurant in your area or whatever, you look at earnings. What am I buying compared to what am I paying? Today, investors are paying some of the highest prices for stocks compared to the earnings that they make. But if you look at the alternatives to generating a return, about 75% of the world's bonds yield less than 1%. As an insurance broker, you obviously know that what insurance companies do, or property and casualty insurance specifically, or Warren Buffett even more specifically because he came up with this, is they take all the premiums in advance, and then they have a float. Basically, this is money that is that they need to keep on reserve in case that there are claims on it. But in the meantime, they get to invest it. That's a float. Where insurance companies invest this float, this is billions and billions of dollars of your money, basically, that you paid. They may well retain it, but for the meantime, they have to keep it in reserve. They get to invest it tax-free. That's how insurance companies become giants. And usually they don't want to do the stock market, they do bonds. Now they can't do bonds because you can't generate a return. You're getting less than 1%, the inflation is higher. Pension funds, same thing. Throughout history, throughout the 1980s, the 10-year bond, so you lend Washington money for 10 years, you get 8, 9, 10%. In the 90s, it's about 6 to 7%. In the 2000s, it's about 4 to 5%. Still great returns overall for very low risk. Today, 0. And so when you have this challenge, then stocks are just worth more. Companies are worth more. You can pay more for companies if there is no other alternative. Because if the dividend yield of the S&P 500 is 300 or 400% larger than the yield on the 10-year bond, there's a point where pension funds and sovereign wealth funds and hedge funds, etc., they just stopped with that 60-40 mentality because they were not earning anything on their bonds. So this is one thing that is driving stock prices much higher. Secondly, think about all of the real estate investors who cannot invest in hotels, casinos, construction of retail, all these, very troubled industries, and they have to go towards stocks. Now, some of these stocks, you look at what they did in time of COVID, and they had a lot of their expenses offset, and their expenses basically went to the government. Government is paying their salaries for a lot of the employees, and they can lend and they can borrow money from the government to pay a lot of their expenses. So a lot of companies have adapted really quick. Talking about the multinational companies, and as you well pointed out, the S&P 500 is only 500 companies. The Nasdaq 100 is 100 companies, and the Dow 30 is 30 companies. So this is a collection of 630 companies, and most of Americans have nothing to do with these companies. They don't work for these companies, and they don't own shares in these companies. 84% of the stock market of the S&P 500, etc., is owned by the top 1% of Americans. Let me say that again. 84% of the equities are owned by 1% of the people in America. Wow. So most Americans have, they don't, if the Dow is 30,000, that's the annual salary. That's the annual median salary for most Americans. It's the median salary, basically, post-tax. So if it takes you 1 year to buy the Dow, that is an all-time high, by the way. In 1980, it took about 10% of that. So you could about 10 times more and be part of the American enterprise system. Today, it takes you a year. That's insane. So that's why you have this wealth gap. Why did this wealth gap happen? Why is there such an income gap? One thing is education. When education is so expensive, there's a certain segment of the population that can never enter college, can never go into technology, high tech, etc. They're stuck 30, 40 years behind in industries that are getting either outsourced or automized or whatever else, and just they're frozen. Their salaries are going to be frozen, etc. So that's one thing, education and the cost of education. Secondly, what you have in America is the financial system is predominantly handled by the central bank. And the central bank does not really touch Darren. It can't reach Darren. It can lower interest rate, which indirectly can signal to Darren, hey, maybe Darren should, instead of rent, take a mortgage. And that will fuel the real estate economy. But they never touch the real thing. Whereas the government, it can come to Darren and say, hey, Darren, you want to buy a house? We'll give you 2 years of tax breaks. That's touching you directly. And I'm not an American, and I'm not a political animal, so this is not a political bashing or something. But during the Obama years, the government was pretty much laid back on on doing fiscal policy. They left everything up to the central bank, and the central bank wanted the baton handed to the government, but the government just didn't take it. And so after 2008, you lower interest rates, you get over the hump, you get a lot of deficits because of this, but then the government needs to start, maneuvering the economy, and it didn't. Trump, on the other hand, is very proactive. Maybe he does a lot of mistakes. We'll have to judge that, a few years down the road. But he's very active. Tax cuts, opportunity zones, working on a trade deal with China. These are all things that touch the people. And obviously, PPP, PPE, all the things that are happening right now, that's the government and not just the central bank. That's what you're going to see going forward. It's a marriage of doing both of these together because interest rates are already at zero. So like a big answer to your question is there's the real economy where 54% of Americans are employed. That's your small businesses, mom and pops. And then there's the rest. The rest are doing pretty well because the central bank has created a situation where they have a lot of liquidity. This is very unusual for a crisis. Usually in a crisis, all the credit contracts, like you saw in 2008. Here, there's the opposite. There's all the credit in the world. So, companies can even if they have much lower earnings, they can borrow money at very low costs and get through the hurdle. This is the multinational company, the big company. The small companies, they have much more issues. They don't have access to the debt market and the credit markets. They have nothing to do with the central banks. That's why the government had to help them. Otherwise, you would have seen a collapse of small businesses and just big businesses buying them, and there will be even more gap than it is right now. And so that's basically the dual economy that we have. We have, on one hand, assets prices that are totally elevated because governments are telling you, hey, if you lend me money, in 10 years, I'll bring you back your principal, but no interest. So that forces people to go into the stock market. And then you have the real economy, which depends more on government stimulus, and it's not as open to all of these advantages of cheap credit, and it's struggling. And that back and forth is what's causing riots and populism and everything else, because people are saying, hey, this is not fair. This is not capitalism. I'm not enjoying the fruits of capitalism. I'm only enjoying the two wolves deciding what to eat for dinner, and I'm the sheep. So it's fine that two wolves have raised their hands and we're in a democratic system and in a capitalistic free market. But I'm always losing, and so I don't like it. So that's where America is right now, and there are clear winners, clear losers to the system.
Yeah, I think everything you talked about. I mean, I get it. I think it's frustrating for most of us that support a free market, but yet you see it's kind of a bastardized market when you have the government pouring cash into it. It doesn't allow the winners and losers like you would normally expect. It tries to keep falsely in some cases, and maybe reward some with additional liquidity to where they can have those opportunities down the road to take advantage of those opportunities when they come. But that would, I guess, if everything was equal, the people that have more capital probably had more capital to begin with, in reserve. They were probably operated differently as opposed to the people that were, sink or swim kind of a model there. So when you assess a company, you mentioned talking about looking at earnings and stuff. How are you in this market, given this infusion of cash from the governments? How do you reason through that? Because without that, I think you could assess, company A versus company B, or make some sort of a determination. But there's a lot of, I've heard people talk about it's kind of like driving in fog. You turn
Mm,
the lights on, you can't see where you're going, and everybody's kind of in the same,
okay.
how do you take a look at that? And when you're making a decision to invest, how are you sorting through the fog?
Sure. Okay, so there are industries that have really been affected by COVID-19. Those are real victims, right? Hotel chains, casinos, cruise lines,
Hospitality. Yep.
hospitality, oil companies, tourism, the airline industry. Okay, so you put all of these in one basket, and then within that basket, you look for very specific things, and I can touch upon that. So those are the real casualties. A lot of in the food industry, companies like that. Put them in one batch, and retail, okay, malls, etc. Let's put them in one batch, and they are basically whoever is sporting companies, whoever is really impacted either by government restrictions, literally the government telling you you can't operate this business, or you have to operate within really crazy restrictions, cinemas, etc. Put them in one basket. Let's touch upon them later. And then you have the ones that are thriving, the ones that this is like the government telling you, I'll eliminate your competition for you. You know what I mean? There will be no retail stores. Online will go big. For example, Amazon, right? So these are the two companies, and then these are the two extremes. Those that are being victimized, those that are being benefited, and then there's in the middle all the companies that are sort of chugging along in terms of they haven't been too much impacted for the bad side, too much for the upside. What most investors are currently doing is that they're trying to buy a company at X, and a few weeks or a few months later, just sell it for a higher price. And that model, it works until it doesn't work. In other words, there's a top somewhere for the price. I don't do that. For the most part, I avoid trying to buy a company for X and gambling or speculating that somebody else will pay more for it in the future. What I try and do is look for a company that I buy at X because I can see that its earnings are currently pretty good, or that I think they'll come back to normal real soon, and its price is cheap compared to the growth of the company going forward. And therefore, what I care about is the cash flow this business will generate in the coming years and decades to come, and not that I buy at one price and I can sell it a few weeks later at another price. And so that's my model to begin with, because people have to realize that price appreciation is only 40% of historical returns for the stock market. The additional 40% is dividend distributions. And then the additional 20% is what we call buybacks or share buybacks. That companies that are instead of using their capital to distribute the dividend, are basically telling you, we'll buy more shares of our own company, we'll close the pool of shareholders, and you'll own more of the company tax-free. Okay, so that's just a bit. It's at some points this is even better than a dividend. Okay, so now that we've done that, we want to look at companies that are almost a monopoly in their industry. Companies that have very few competitors, either because they operate in a very tricky industry. In other words, it's hard to compete. Even if you raise the capital, you won't be able to come in. So they either are operating with very low, very thin margins, and therefore if you try to compete with them, you'll probably get eaten alive, or they have a special relationship with the government or with some sort of a regulator that it's hard to compete with, or they have a lot of brand loyalty, and it's hard to shift the trend towards a new company, or that they're one of the dominators. There are 2 or 3 dominators, and no one else can get in. It's very hard to get in, and that would be because of economies of scale. For example, other companies will have higher cost, if you can find those types of companies that have what I call a moat, something around their business that makes it very hard for others to compete with, then you have a chance at finding something that will beat the index. Because otherwise, it is pretty much a certain that if you just buy an index fund and you wait at least a business cycle, so at least 7 years or more, you will start seeing how consistent the returns are. In the past 100 years, the S&P 500 has returned 8.3% a year, but only on 4 calendar years out of 100, it actually closed the year close to that 8.3% average. In other words, it's like having one hand in boiling water, the other hand in ice. If you combine it, it will probably have a nice feeling to it, but both of your hands are one is having froze bites and one is having it's in hot water. So you have to realize that over the long term, the American enterprise is doing very good. You're going to make a fortune betting on American companies. But if you know how to find companies that even grow faster than the index, then you have something unique. 93% of investors underperform the index, and they should just invest in the index, and they should probably double down or pile in more after a huge correction. For example, what happened in March, that would be an amazing buying opportunity. And for the rest of the people that have a succinct way of understanding businesses, they can outperform that. Now, over the long term, if you invest for 30 years, the difference between earning 8% a year and 12% is meaningful. Over 1 or 2 years, it's almost negligent. It's a few $1,000s depending on how much you're risking. But over a 30-year period, when you compound that, that's an insane difference. So that's where you have to figure out, am I capable? Do I have the time? Or do I need to offset this to somebody else? How do I do this? And that's basically the business. So one, competitive advantages. That's the main way to find a phenomenal business. And then if it's a complex of knowing the industry, knowing this, knowing that, understanding the books, the numbers. That is what being an investor is. It's a profession. Many people do not see it as a profession, and therefore many people lose a lot of money in the stock market.
No, I think everything you touched on there. I was kind of surprised you mentioned that only 40% of the returns is through price appreciation. Is that true even over the longer haul, or is that
that is true only in the longer haul?
Okay.
Day to day, no. I can't tell you what we'll have from now until the end. But over the 100 years that they did this study, 40% comes from dividends, 40% from the appreciation of the price, and 20% from earnings growth, buybacks.
No, that's interesting. That's great. Hey,
you can find that study online, by the way.
No, I appreciate that. I want to ask you quick. I know you're a fan of gold. Can you speak to gold as to how it's held up and give a little perspective on gold?
Sure. Today I'm a big fan of gold. Not only a fan. Gold is trading at an all-time high, and more importantly than gold trading at an all-time high, which is amazing. And if you go to our website, for example, for Wealth Research Group, and you click on that top menu, you'll see special reports. Lots of them have to do with gold. So if you don't know why gold is important to have as a part of your portfolio, you can definitely download some of those. And also go to wealthresearchgroup.com/gold playbook, which is a special report we created for your listeners. That's a very comprehensive manual on investing in gold and silver. Okay, so gold is also, it's almost like a mirror of other things that are happening in the economy. And the most important thing for gold is that investors like to own it when the interest rates that they can get either at their bank or by buying bonds is negative. So let me say that again. If you currently want to do the safest thing in finance, traditionally, you go and you purchase and you lend Washington money for 10 years. The 10-year bond is the barometer for all the other assets in the world. Okay, that is, whoever you ask, any professional investor, he will tell you the barometer is the 10-year bond. So today, the 10-year bond is yielding 0.5%. In other words, if you lend Washington $1 million, you'll get 0.5%. So that's $5,000 of interest a year for $1 million. And then you have to deduct inflation. Inflation is 1.5%. And therefore, in real terms, you are losing $1,000 every year on this transaction. You are lending in money at real negative rates. When that happens, gold soars historically. So that is exactly what's happening right now. The 10-year bond right now, in real terms, so whatever the nominal yield that you see on when you're quoted online, minus the CPI, the Consumer Price Index, is the lowest it's ever been. It's minus 1%. And in that kind of environment, there's a lot of institutions that say, I am not going to just lose money. I'm not going to lend money to Washington knowing that I'm losing money. I'll just buy gold. And that's what's happening right now. That's why gold is over $2,000 an ounce. And it will continue on doing what it's doing if there's no change in that. And to me, it looks like there's not going to be any change because the chairman of the Federal Reserve, the central bank, is saying we are probably done raising interest rates for a few years. And so if interest rates are going to stay the same, and I think inflation is even going to go up a little bit, then rates are going to go even more negative. Secondly, you have a dollar bear market that has just started 2 months ago after 10 years of a bull market. Now, the dollar, what is it? What is a dollar bull market and a dollar bear market? A dollar bull market is if the dollar's value, relative value, is rising compared to a basket of other leading currencies, the euro, the yen, the Canadian, the Australian, the Swiss, the Hong Kong, etc. And it was on a beautiful 10-year bull market from 2010. It just broke down below that support line, that 10-year support line, and it's in a bear market. A dollar bear market is the most important financial event, or dollar bull market is the most important financial event because it determines so many other things. Because the dollar is the reserve currency that everyone uses. And dollar bear markets historically are 6 to 7 years long. And so if we just started one that has insane repercussions for commodity prices, and you've seen in the last 2 months or 3 months that silver's price has gone up 100%. That's the smaller precious metal, the one that's much more correlated or inversely correlated with the dollar. And so you're seeing phenomenal returns for gold, silver, gold stocks, silver stocks. Some of the stocks that we've profiled in our own portfolio are up over 100% in 3-4 months in the newsletter. So that's what happens when you have a bull market in commodities, specifically in the mining sector.
I appreciate you taking us through that. The precious metals are I know they have their times when they're more sought after, and it sounds like the way you described it now is definitely a time to make certain you have some in your portfolio. Lior, if we could, I'd like to shift gears here for a second. As I mentioned to you before, by day I'm an insurance broker, and I work with my clients to assess risk and do some risk management. There's a couple of strategies we typically consider. We first look to see if we can avoid the risk. If that's not a possibility, can we minimize the risk? And when that's not an option, then we look to see if we can transfer the risk. And that's what an insurance policy is. And I like to ask my guests, if they can identify what they consider to be the biggest risk.
Okay.
And for clarification, I'm not necessarily looking for an insurance-related answer. You can apply this however you feel. If you want to look at your business, your client's business, however you want to frame the question is up to you. But with that, if you're willing, I'd like to ask you, Lior Gantz, what is the biggest risk?
So I think COVID-19 is changing a lot of habits that people have. Some habits changed faster and for certain people. Some habits have not changed, and some habits are slowly starting to change. And it's very important to see that you're not out of touch with what's happening. In other words, that you don't think that the way that you're being changed by COVID-19 is the way that your clients are being changed by COVID-19. Therefore, you will take your business one way because that's what personally is happening to you, your own personal experience, whereas your clients are looking at a different route to go forward, and you're going to lose them to competition. So the biggest risk right now is not understanding how your client has changed, if it changed. And I think that's really important for people to stay on top of. Now, if you're an employee, which most people are, your client is your boss, and you need to see if he's changed. If his business is more vulnerable, you should look at moving to a different business. If his business is full of problems, but he also has liquidity to get through it, then you can bring a lot of value by solving problems, and you can move ahead in the company. So just think of that. Understand that everyone right now is experiencing either multiple problems, or they're experiencing a boom because basically the government has benefited them. If you want to be part of that, be part of that. In other words, go with companies that, and with industries that have a huge tailwind, or go to the victims, because you're going to have opportunities to make huge, significant impact on them because they need so many new ideas and fresh solutions. So either or, but just know that this is a phenomenal time to show your value. That is the key point. Just think of the experiment that no business would have ever taken to close it down or to put all the employees home. These are unheard of, and they've happened now. So you have to be conscious of that, and that is the biggest risk. Losing the mindset of your client because he's changed and you no longer understand what he wants and what he needs.
No, that's well put. And I think it's a good reminder for people to recognize there is an opportunity here, and in every crisis, there is an opportunity. And it's up to you to find that and be the solution there. So that's great. Lior, where can the listeners go if they'd like to learn more or connect with you?
wealthresearchgroup.com. The homepage, you can sign up for the newsletter. That's literally like the best way to stay in touch with whatever I'm doing.
Got it. Lior, I can't say thanks enough for taking the time. I've enjoyed talking with you again, learned a lot, and I hope we can do it again soon.
Thank you, sir.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.